84% of retirees make this Social Security mistake, and most of them never even know it happened. This is not a small error. Research shows the average retiree loses $111,000 in lifetime income from this single mistake. I'm Warren Jr. Today I'm going to show you exactly what this mistake is and how to make sure you don't make it. According to the Center for Retirement Research at Boston College, 84% of retirees claim Social Security before age 65, and only 10% of eligible retirees ever claim at the optimal age of 70. Just 10%. That number should alarm you. But here's what makes this truly hidden. Most retirees who make this mistake genuinely believe they made the right choice. They thought they were being smart. They thought they were protecting themselves. But the numbers tell a different story. So what exactly is this hidden mistake? It is not just claiming early. It runs much deeper than that. Let me explain. The hidden mistake is this: failing to coordinate your Social Security claim with your other retirement income sources. Most retirees treat Social Security as a separate, isolated decision. They do not. It affects and is affected by everything else. Your Social Security benefit interacts directly with your taxes, your Medicare premiums, your IRA withdrawals, and your overall income. When you get that coordination wrong, even slightly, it creates a chain reaction of financial damage across retirement. Today, I am going to break this down into 4 specific coordination mistakes, any one of which can cost you dearly. Coordination mistake number 1, ignoring provisional income. This is the root cause of unnecessary Social Security taxation. Provisional income is a specific ERS formula. It equals your adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefits. If that provisional income exceeds $34,000 for a single filer, up to 85% of your Social Security benefit becomes taxable. For married couples filing jointly, that threshold is $44,000. Above that, 85% of your benefit is included in taxable income. Here is the coordination mistake. Most retirees take large IRA withdrawals in the same year they start Social Security. That combination pushes their provisional income well above the threshold, and suddenly up to 85% of their Social Security is getting taxed. Every year. The fix is sequencing. Draw from your IRA first, before Social Security begins, so your provisional income stays lower. By the time Social Security starts at 70, your IRA balance is smaller, meaning lower required minimum distributions and lower provisional income going forward. This strategy alone, done correctly, can save a retiree tens of thousands of dollars in unnecessary lifetime taxes. Now, coordination mistake number 2. And this one surprises people every single time I bring it up. Most retirees have no idea that their Social Security claiming decision directly affects how much they pay for Medicare. Medicare Part B premiums are automatically deducted directly from your Social Security check every single month without exception. The standard Medicare Part B premium in 2025 is $85 per month. That is per person, so married couples pay $372 monthly. But here is where the coordination mistake comes in. High earners pay significantly more through what is called IRMA. In 2005, if your income as a single filer exceeds $1,000, your Medicare premium jumps immediately to $2,509 per month. And it gets worse. At $13,333 income, the premium rises to $370 per month. At $70,000, it becomes $433 per month per person. Here's the coordination trap. Medicare uses your income from 2 years ago to set your current premium. This is called the look-back rule. So if you had a high income year 2 years before Medicare starts from a Roth conversion, a large IRA withdrawal, or selling a property, you will pay higher premiums today. The fix is planning your income 2 years ahead of Medicare enrollment to stay below the IRMA thresholds wherever possible. This means if you plan a large Roth conversion or IRA withdrawal, time it carefully, not in the 2 years before Medicare starts. Now, coordination mistake number 3. This one affects married couples specifically, and it is widely overlooked. In a married couple, the lower earning spouse can claim up to 50% of the higher earner's full retirement age benefit. The coordination mistake is both spouses claiming at the same time, at the same early age. This is almost always wrong. The optimal strategy for most couples is called the split claiming strategy. Let me show you exactly how it works. The lower earner claims first at their full retirement age, or earlier if needed to bring income into the household. Meanwhile, the higher earner delays, ideally to age 70, maximizing the benefit that will also become the survivor benefit. This strategy gives the household immediate income while protecting the maximum long-term benefit for the surviving spouse. Let me pause here. If this is already eye-opening for you, please hit subscribe. This kind of information keeps coming every week. Now, coordination mistake number 4. This is the one that catches the most people completely off guard: the earnings test. If you claim Social Security before your full retirement age and you are still working, Social Security will withhold part of your benefit. In 2002, the earnings limit is 22,320 per year for those under full retirement age. For every two earned above that, one of Social Security is withheld. Most people do not realize that withheld benefits are not permanently lost. The SOC credits them back to you at full retirement age. However, the coordination mistake is still claiming while working because the withholding disrupts your cash flow and your tax situation simultaneously. The simple fix: if you are still working and under full retirement age, do not claim Social Security yet. Just wait. Let me now walk you through a real example that combines all four of these coordination mistakes in one household. This is common. David is 63. His full benefit at 67 is $2,400 per month. His wife Carol's full benefit is $100 per month at $100 per month. He still works part-time, earning $35,000 per year. David and Carol both claimed at 62. Both took the 30% reduction. David also triggered the earnings test on top of that. David's IRA withdrawals pushed their provisional income above $44,000, making 85% of their Social Security taxable. The following year, their high income triggered IRMA and their Medicare premiums jumped by over $1,600 per year combined. 5 compounding coordination mistakes all happening at once. Nobody warned them. Nobody sat them down and showed them this. That is exactly why this channel exists, and exactly why you need to know this before you make any of these decisions. Now let's flip the script. What does the correct coordinated approach actually look like? Let me show you. Step 1 of the coordinated approach: run your provisional income estimate before you make any claiming decision. Every year, add your AG, your tax-exempt interest, and 50% of your projected Social Security benefit. Compare to the thresholds. If your provisional income will exceed those thresholds, consider delaying Social Security or reducing your IRA withdrawals that year. Step 2 of the coordinated approach: plan your income 2 years before Medicare starts. Know your IRMA exposure in advance. If you need to do a large Roth conversion, do it before that 2-year window, not inside it. Timing is everything here. Step 3: if you are married, coordinate your claiming ages deliberately. Do not default to claiming at the same time. The higher earner almost always benefits from delaying to 70. This is one of the clearest, most consistent findings in retirement research. Step 4. If you are still working and under full retirement age, stop. Do not claim. There is almost no scenario where this helps you. Between the earnings test withholding, the higher provisional income, and the potential IRMA trigger, working and claiming is almost always a net financial loss. Now let me address something that comes up constantly. What about Roth IRA income? Does that affect provisional income? This is one of the most powerful features of the Roth IRA. Qualified Roth distributions do not count toward provisional income at all. This means if you have Roth savings, drawing from them in retirement can help keep your provisional income low, protecting more of your Social Security from taxation. This is why doing strategic Roth conversions before retirement can be one of the most valuable moves you make for your future tax bill. We have a full dedicated video on Roth conversions coming soon on this channel. Subscribe so you don't miss that one. Now let me introduce what I call the coordination calendar, the most practical tool for avoiding all 4 of these mistakes together. Age 60 to 62, this is your Roth conversion window. Convert strategically while your income is lower. Fill the lower brackets. Age 62 to 65, begin drawing from your traditional IRA or 401k as your bridge income. Keep withdrawals below the thresholds. Age 63, check your projected income for age 65. If it could trigger IRMA, adjust your IRA withdrawals now, 2 years out. Your premiums are now locked based on your income from age 63. Plan for this far in advance. Age 67, if the lower earning spouse is claiming, this is typically the optimal age. Full benefit, no reduction, no earnings test. Age 70, the higher earner claims, maximum benefit, maximum survivor protection. The coordination calendar is now complete. That 8-year coordination plan, executed correctly, can mean the difference between $11,000 lost and $11,000 protected. Now I want to spend a few minutes on something most videos never cover: the hidden mistake inside the mistake. Even people who know they should wait often pick the wrong year to start. The year matters as much as the age. Social Security benefits are not prorated monthly for the year you start. There are specific month-by-month rules that affect your first-year benefits significantly. Specifically, Social Security pays benefits 1 month in arrears. Your January benefit is paid in February. Your start month affects your first check timing directly. The practical tip: apply for Social Security approximately 3 months before you want payments to begin. This avoids unnecessary delays in your first check. Now let me address the biggest objection I hear. People say, "Warren Jyer, I just don't trust the government with my money." I understand that feeling, but here's the thing: claiming early doesn't protect you from the government. It just locks in less money. The money does not disappear if you wait. It grows at 8% guaranteed per year after full retirement age. That is your money. All right, we're in the final third of today's video. Let me give you something concrete you can use this week. Action 1, go to Saytagab this week, create your account, pull your social security statement and write down your benefit at 62, 67, and 70. Action 2, calculate your estimated provisional income. Add your expected AGI, any tax-exempt interest, and 50% of your projected social security. Compare to the thresholds. Action 3, if you are married, sit down with your spouse and specifically discuss which of you claims first and which of you delays. Do not leave this to chance. Those 3 actions done this week will put you ahead of 84% of retirees who never do this planning at all. Let me now give you the 4-question test. If you can answer all 4 correctly, you are ahead of almost everyone. Question 1. Do you know your provisional income and whether it will push more than 50% of your Social Security into taxes? Question 2. Do you know your projected Medicare premium for the year you turned 65 based on your income 2 years prior? Question 3. If you are married, have you and your spouse decided specifically who claims first and who delays to 70? Question 4. Do you have a plan for sequencing your IRA withdrawals, Roth distributions, and Social Security across the bridge years? Is it written down? If you could not answer all 4, that is not a failure. That is simply information you did not have yet. The 84% who make this hidden mistake are not unintelligent. They simply were never shown the full picture. You have been now. Let me now give you the 3 biggest takeaways from everything we have covered in today's video. Takeaway 1, Social Security is not a standalone decision. It must be coordinated with your taxes, Medicare, IRA, and spouse. Takeaway 2, provisional income is the hidden tax trap inside Social Security. Know your number before you claim. Takeaway 3, the coordination calendar gives you a clear 8-year roadmap. Follow it and you protect tens of thousands. In our next video, we are going deep on Medicare, specifically the enrollment trap at 65 that permanently increases your premiums. Subscribe so you don't miss that one. It is a mistake that can follow you for the rest of your Medicare years. If today's video helped you, please share it with someone you care about who is within 10 years of retirement. They need this. Leave your question in the comments. Tell me, did you know about provisional income before today? Let me know below.